Hi, in this video, we are going to briefly go over the basics of the oil and gas industry. This is a short clip from a longer oil and gas accounting basics video. If you want to learn more, please view the larger seminar. If you learned something new, please like, share, and subscribe.
So basically, the natural resources industry group is made up of these segments you see here. Upstream, which is going to be your exploration, drilling, and production. You have midstream, which is going to be your gathering, your transporting, storage, treating. Downstream, which is mostly kind of refining and chemicals, and then you have your oil field services, and these can really be a wide array of services. There's a few listed here, but there's companies that manufacture parts and equipment for the industry, that do all sorts of things. So the next slide here is just an illustration of the previous slide, just kind of showing you which activities fall into the different segments. So here we have some examples of products made with petroleum. I think, a lot of people probably underestimate how many things we use on a day-to-day basis that are made with petroleum products. This list here is really a tiny fraction of the items that are made with some type of a petroleum product. I read a 2020 study that showed that gasoline makes up only 45% of the U.S. petroleum consumption. So what that means is that, in the future, even if electric cars were to replace the majority of our gasoline burning vehicles, that we would still need petroleum products for the other 55% of our U.S. petroleum consumption. And for that, percentage, currently there's no scalable substitute. So, I think that's just kind of evidence that, the industry is not going anywhere anytime soon. There's still great need for these products. So the majority of the accounting concepts and calculations that we're going to go over today are going to be geared towards the upstream space, because that's just kind of where those technical accounting concepts reside. So I just want to walk you through kind of the phases of that, the upstream space real quick. So, really it starts out with your preliminary exploration activity. That's going to be your 3D, 4D seismic studies, exploring assets to, try to discover, economic reserves. And once you kind of analyze the seismic data, then you kind of begin the leasing phase. And so this is, going out to people that actually own the surface land and the mineral rights. Could be individuals, could be estates that have been passed down, through families, and negotiating a lease agreement, right, to obtain access to be able to drill and access those minerals. And so normally in these lease agreements, there's going to be a lease bonus that's paid to the mineral right owner. It's usually, per acre. And then they also will usually have a royalty that the mineral right owner will receive once they begin producing on the lease. So the next phase is exploring the leased property, so drilling an exploratory well and doing further analysis. And that kind of leads into evaluating and completing, testing that there's sufficient reserves to begin developing the property. Once sufficient reserves have been found and the property is deemed economic, companies will begin drilling additional wells and installing surface equipment. And then they begin, producing the property. So, selling the separated oil and natural gas on an economic timetable. And then the last phase of the E&P, or the upstream space, is the plug and abandoning of the property. So this literally means plugging and sealing the wellbore below the surface and removing any equipment to really, restore the property to its original state before any of the activity began. And this is done once a well reaches its economic limit. And one thing I would point out on that is, a well's economic limit could be anywhere from 2 to 3 years up to 50, 60 years, kind of depending on the nature of the well. So So this slide here kind of lists out some of the risks that the upstream space is exposed to. I'm sure if you have some public E&P companies, you've seen these listed in their risk factors. I would say that some of these can have a greater impact on international companies and offshore drilling companies. But nonetheless, these are things that you have to consider from year to year, the impact on your company. Disasters and pandemics. Obviously, we've seen what COVID has done to the industry over the last couple of years, the impact it's had. Weather, obviously, that's always a big issue. I would say, for offshore, it's an even bigger issue when there's a hurricane or something like that coming in. They have to, evacuate their rigs and make sure their people are safe. Politics, obviously, companies need to stay informed on the agenda of the current president and the administration and how they regulate the industry, no matter what country they're operating in, and whether the administration is kind of pro energy or anti. OPEC, obviously, we've heard the term OPEC. That stands for the Organization of Petroleum Exporting Countries. OPEC's been around for 60 plus years, and they at times have been able to kind of manipulate pricing in the industry because what I think a lot of people probably don't realize, you hear the names of these big companies that you see listed here, like Exxon, Chevron, BP, Shell, but realistically, these companies control probably less than 10% of the world's oil reserves. These government-sponsored national oil companies, they control around 80% of the global oil reserves. So that's why they're able to kind of manipulate things by increasing and decreasing supply. Next one listed here, just war. Obviously, when there's conflict in the Middle East, we've seen what that can do to the supply chain globally, and what the volatile price environment that can create. And then drilling risk. This is one you have to kind of think about. There's been technological advancements in every industry, and as well as oil and gas, and they're drilling well bores now that are 30, 40,000 feet. They're drilling what they call lateral legs that are 2 miles long, and so with that, there's more pressure and safety issues when you're drilling down in these more remote areas. So that's something else to consider as a risk. So the next slide here are just some common oil and gas acronyms. I would say this is something that's really unique to the industry. There's a lot of acronyms in the oil and gas industry. A lot of these on the screen are more so measurements of how they measure oil, natural gas liquids. A few I would point out that'll probably come up in some of the later presentations. D&C, which stands for drilling and completion. So these are the cost incurred to drill and complete a well. And you may see this acronym even in a company's trial balance of accounts. They may have it listed as tangible or intangible D&C. So that's what that stands for. DSU, that's drill spacing unit. So that's talking about the distance between well pads, and it's kind of dictated by where they're drilling. JIB, that's one you're going to hear probably a lot today. So that's a joint interest billing. And that's just, a company that operates wells that's not responsible for all of the cost. They will send out a joint interest billing to their partners to recoup the cost, whether it be capital or operating cost, for their partner share. LOE is lease operating expense. So this is one you'll hear a lot today as well. Once a well comes online and is producing economically, then these are the costs that get taken to the income statement as just operating costs. And then at the bottom, you'll see P&A, or plug and abandon well. So we kind of talked about that one on a previous slide, and we'll get into that more in the ARO section, and how the P&A cost estimate factors into that ARO calculation. But P&A is also an acronym that you'll hear a lot in the industry. So this slide here is kind of listed out the reserve categories. And again, you're going to hear these referred to a lot today throughout the presentations. And the presenters will get into this more in detail on how the different reserve categories factor into the depletion and impairment calculations, you know, depending on the accounting method that the company follows, whether it be full cost or successful efforts. So don't need to memorize these, just trying to kind of get a general understanding of what they mean. So proved, developed, producing, or PDP reserves. So these are economically recoverable with 90% certainty and are usually in the process of being produced. PDNP, these are reserves that are usually behind pipe or shut in currently, but that can be accessed with relatively minor cost, and they're also subject to the 90% certainty criteria. You may actually hear these referred to as PBP, which is proved behind pipe, or PSI, proved shut in. There's several different acronyms they use for the reserves in this category. Proved undeveloped, that's kind of what the title states. It's reserves that are expected to be recovered from either new wells on undrilled acreage or from existing wells where there's going to be some major expenditures, you know, so it's generally undeveloped properties, but they still have the 90% certainty. And then probable reserves, so these are going to be economically recoverable with 50% probability, and then possible reserves are going to be economically recoverable with 10% probability. I think it's just good, you know, when you talk to your clients or reserve engineers or people in their operations group, and they refer to 1P or 2P or 3P reserves to kind of understand what they're talking about and you know, which reserve categories fall into those buckets. So
yeah, so I'm going to talk about the exploration process now. So there's a few things listed here: the geological and geophysical studies, geophysical surveys. This is kind of the research and studies that go on before you get into the drilling stage, right? You want to make sure there's oil and gas underneath in the ground where you're going to drill. So these are some techniques that they use to try and validate, you know, get information about what's below the surface. And, you know, in the picture here, there's an example of a seismic study where the truck here would kind of generate an acoustic sound signal or a seismic signal that's transmitted into the Earth's surface, which would then reflect off the various geological layers down there and provide, you know, information and data to the reserve engineers that they can use to kind of make their decision right on whether they want to drill, whether they see economic quantities of oil and gas beneath the surface that would, you know, they would want to drill. You know, once they make that decision, they'd enter into a lease agreement to lease minerals from the mineral rights owner. You'd then get into kind of drilling exploratory wells, where you'd go and explore further whether there's, you know, economic quantities down there. They can be referred to as exploratory stratigraphic test wells, and if you're offshore, it can also be referred to as a appraisal well bore. And these are just used to run tests, build-up tests, stem tests, various other tests. The idea being, you know, we're kind of exploring to see if there's economic quantities of oil and gas here beneath the surface, right? Okay, and this next slide talks about the drilling process. So once you actually have made the decision to drill, right, you'll have some initial site development to get the site ready for drilling. Then you'll have the actual drilling process where you have a drilling rig used to drill, you know, into the rock formation. This can be conventional vertical drilling or horizontal drilling. The next slide will kind of get into that a little bit further. Completion is just refers to the work performed, the installation of permanent equipment for production of oil and gas from a recently drilled well. So this is just, you know, the final stage is completing the well. And then production just refers to when the well begins to produce oil and gas. So the initial production stage, and from then it's kind of considered a producing well. So this is a depiction of some how that would work. So on the far left, you kind of have a traditional vertical well, right, where it just goes straight down, and then to the right of that, you'll see it kind of, there's a horizontal one where they can kind of shift directions when they hit their target when they hit the gas-rich shale. So you'll see on the top left, that's a conventional non-associated gas, and so that's a natural gas that's not in contact with crude oil. Whereas on the right side, you have more conventional associated gas. So that's natural gas occurring in the form of like a gas cap that overlies an oil zone. So just kind of technical stuff, but just something to be aware of. The tight sand gas, that's just a rock formation when there's just small densely packed particles, so they're just tight formations. But yeah, no, this is just kind of an illustration of conventional and non-conventional, and the vertical drilling versus horizontal. The types of oil and gas interests, so you have royalty interest and working interest. Royalty interest is kind of considered, I would consider that just kind of a revenue only. So you're just going to get a share of the production, so you don't share in any of the costs. Whereas the working interest, you're going to share in the costs, and then after the royalties are paid, you would also share in the revenues. So royalty is going to be, like I said, revenue only. Working interest, you're going to have to share in the costs as well. But this is just the interest in the oil and gas wells that owners can have, and how they share in the production and or costs that are associated with each individual well. And it's worth noting that these can be broken up into many owners. So each well can have hundreds of different owners, and they can be different between the royalty and the working interest. So when you get into that in testing, you'll see that we have to do a lot with the decks that kind of determine the interest in the well. So you'll see a lot of this when it comes to royalty interest and working interest. In terms of the products produced, obviously you have the oil and natural gas. Those are obviously the well-known ones, but salt water is also a frequent byproduct of oil and gas production. So it's a waste item, so it has to be disposed of in a safe manner. And customarily, you will see that it's gathered and re-injected back into a subsurface formation. Oil and natural gas, obviously, we're aware of those. Natural gas liquids, generally that represents hydrocarbons, which are extracted from wet natural gas, and they can become liquid under various combinations of increased pressure and lower temperature. That consists primarily of ethane, propane, butane, and natural gasolines. So that's kind of the products that you generally see produced from oil and gas wells. Oil price history. So as you can see, very volatile. Late 2000s, you had a big spike, oil going almost up to 130 range, and then it crashes back down to sub 50 very shortly thereafter. Here more recently, you saw with COVID, oil going down in the 20s, and I think it even went negative one day. So very volatile, just something to be aware of, that you're never too far away from a potential impairment trigger when it comes to your oil and gas properties. You just got to be aware of the volatility that's associated with the oil and gas commodities. So that's really just depicting that here. Same thing with gas. Similar to oil, you had kind of a good times in the early 2000s, and that kind of tailored off in 2010 and kind of trailed beneath that ever since. Again, here recently with COVID, you saw a downtick, but actually gas has actually done pretty well here in the immediate turn, or in the recent past here in the last year or so. It's back up above levels we haven't seen in close to a decade. So it's back in a positive place, where there's a lot of oil and gas companies that were gas heavy over the last decade really struggled to survive. Now there's pricing that really supports a healthy environment for them. These are the major U.S. plays. So, a lot of our clients are going to be here in Texas. We have most of the production coming out of Texas, out of the Permian and Eagle Ford. Permian's out in West Texas with the Delaware. Eagle Ford's down in South Texas. A good chunk of our clients are going to be in one of those two basins, but also, we have various activity throughout the other ones. Up in the north, you have the Bakken. Going south from there, you have the Green River, Piceance Basin, and then in the northeast, you have the Appalachian, Marcellus, and various others. But, this kind of just depicts where all the major plays are. But like I said, I think a big chunk of us will be in the Permian and Eagle Ford for the most part.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Hey, before we continue, let me quickly tell you about a collaboration we are doing with the TB4A Shopify account that can save you some money and help support the channel in the process. Are you an accountant with a sense of humor, but are having trouble expressing that in the third meeting this week about account reconciliations? Maybe you're struggling to find that gift for your accountant friend or their new kid. Or maybe you're struggling to find some not-so-average office gifts. If so, check out TB4A's Shopify and get all the great business comedy gear. They're uploading new items each week. Use my code ACCOUNTINGACADEMY, all one word, for 10% off your purchase. Each sale will indirectly support this channel. Imagine bringing this fun cup to your next pointless meeting. So check out the link and see what you can find. Now back to the video. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.